Right now, money is being created out of thin air. Your screen lights up. And suddenly, it exists. Not printed, not earned, just created. And in 2026, banks will do it faster, quieter, and more invisibly than ever before. Most people still think banks lend out money that already exists. They imagine vaults stuffed with cash, careful counting, and money moving from one account to another. But modern banking is nothing like that. When a bank approves a loan today, it doesn't pull money from someone else's deposit. It creates new money the instant the loan is approved. Imagine opening a faucet. The moment you twist it, water flows, and suddenly your bucket fills. That water is money appearing in your account, real and spendable. By 2026, this process will be even more automated. Algorithms will decide in milliseconds whether new money should exist. Your credit score, spending patterns, and even your app activity feed into systems that generate money digitally, without a single human approving it. On the bank's balance sheet, an asset appears in the form of your loan, and a liability appears as your deposit. It looks perfectly balanced, almost elegant, but psychologically, it's revolutionary. Every unit of currency born carries an obligation. Money is no longer a neutral tool. It has a promise tied to future effort. And because transactions feel seamless and digital, most people won't even notice it happening. Deposits are no longer just savings, they are signals. Banks analyze them like data points on a radar. If your income is steady and your spending predictable, the system decides it's safe to create more money. Think of it as planting seeds in fertile soil. The more predictable the soil, the faster the seeds sprout. This creates a feedback loop. Stability encourages lending. Lending creates money. Money inflates asset prices. And rising assets make people feel wealthier. You don't feel richer because of what you earned, but because the system treats your future as more valuable. By 2026, banks rely on this psychology. They don't need everyone to understand how money is created. They just need people to be comfortable spending, borrowing, and living in a world where money feels abundant. Debt loses its sting, replaced by smooth monthly payments that mask total cost. People experience access, not borrowing, and the system works quietly, invisibly shaping behavior and risk tolerance. Speed is the game changer in 2026. Banks are no longer places to store money, they are engines of continuous credit creation. Embedded finance allows loans to appear inside apps, platforms, and marketplaces, without you ever realizing a bank is involved. Buying a new gadget could automatically become a loan, or subscribing to a service quietly turns into a long-term obligation. Each of these moments is a drop in the river of new money entering circulation. It feels like instant access, your lifestyle upgraded without the friction of cash but behind the scenes. Debt is being born. Banks are masterful behavioral engineers. They separate the emotional thrill of spending from the abstract reality of debt creation. By making money creation invisible and seamless, they reduce resistance and increase participation. Imagine a video game where every reward you unlock secretly costs you future points. You feel progress in reward, but the cost is hidden. That's exactly how modern money works psychologically. Central banks watch this ecosystem from above. They rarely control individual loans. Instead, they shape the environment that makes lending attractive or risky. Interest rates, liquidity policies, and regulations act like the weather. When conditions are sunny, lending expands and money multiplies. When storms loom, banks hesitate to create new obligations. Economic slowdowns feel sudden because the faucet of money doesn't turn off, it slows. Psychologically, this feels like scarcity. Even if balances still appear high, people blame themselves or governments, rarely understanding that credit creation simply paused. In 2026, this invisible push and pull will be more precise than ever, with central banks influencing flows through subtle digital incentives rather than direct intervention. Digital currencies and tokenized assets layer onto this process. Even if central bank digital currencies exist, commercial banks remain the primary creators of spendable money through lending. The interface may look different, more programmable, traceable, and official, but the psychology remains. Trust increases borrowing. Borrowing creates money. More money fuels more trust, tightening the cycle. People begin to see money not as earned labor, but as a stream of future promises. Banks sell time, selling access to income before it exists. In 2026, this trade is smoother, faster, and normalized. Money feels constant, available, and frictionless, reshaping how people perceive risk, patience, and ownership. The most important consequence isn't inflation or interest rates, it's perception. When money creation is seamless, people internalize that cash is always available. Long-term thinking erodes because the future feels pre-spent. Ownership feels optional. Banks teach this silently. Each approved loan whispers the same message: you can have it now, pay later. By 2026, money creation will be invisible yet omnipresent, shaping behavior, risk tolerance, and society itself. What was once hidden in paperwork is now embedded in daily life, making money creation not just a financial process but a defining force in how people live, think, and decide.